From a professional soccer career to becoming a driving force in the mortgage industry, Brian Covey has shown what it takes to find your competitive edge. Get off the sidelines and get in the game. Find your competitive edge with Brian Covey.
What's up, guys, and welcome back to another edition of Finding Your Competitive Edge. So today's a special one because you know I love to talk about mortgage, what's happening in the housing industry, and good grief, 2024 has already started off a little different than we thought today. So if you keep your head under a rock, maybe you've not heard of HousingWire or Clayton Collins, but I will tell you this, they have been one of the foremount groups that has not only covered the news, let people know what's happening, giving you new podcasts and shows to help you keep up with the market, everything that's there. But every time I look up, they're expanding. Another podcast here, another event there. And what I love about our conversation today with Clayton is we're going to dive into not only his journey as a CEO and entrepreneur, how they've pivoted and what they've done with HousingWire, but guys, we're going to jump into what you really want to talk about is what's happening in the industry, where are the changes happening. We've all seen more than half of the originators have left the business. They didn't even come back. Hopefully that's not you. If you're listening to this, we want to equip you with the tools and the resources to help you win and be successful. So I'm excited for this conversation. I love going to the HousingWire events. We're going to mention one of those. I'll just plug it now in April for the gathering back in Dallas. We'll make sure we have the info, all the stuff there for you. But we're going to jump in because I want to talk to Clayton. I want to find out what's going on in the housing market and make sure we get his story jamming. So let's go, Clayton. Welcome, my friend.
Brian, thanks for having me. Thrilled to be here with you in Nashville today.
How about it? So you flew in, which is really cool.
Flew in, yeah. Couldn't resist the invitation to come in. I've been talking to a lot of mortgage execs recently, and one of the questions I often get is like, hey, who's doing things a little bit differently? Who should we be paying attention to? And I'd be lying if I said that your name and Revolution hadn't come up a couple times, and in someone that I'm kind of thinking that is like a model match to think about as someone who's doing things a little bit differently. So the opportunity to come down, spend some time with you, figure we can go into that a little bit in the conversation, but it's worth noting.
I can't wait. Thank you for that. And that's been one, I know we talked about it a little bit, be different. It's one of our slogans we use, and I love that because I think the people that are different and brave enough to be different, I know there's times in my career where I wasn't, and it was the lower points in my career. And when you are yourself, you're like, man, things are just flowing. Whether the results are always there or you see things. I'd love to expand on what you just said, though. So you're talking about, you're having all these conversations. You get to talk to a lot of people.
Yeah.
So people that may not know your journey a little, let's back up a little bit. Like before you joined HousingWire, say just have some context, and I want to jump back into that. I'm gonna put that little placeholder of talking about being different.
Let's do it.
So tell me about starting HousingWire. Like what was the idea? What was really your origin story? Like why did you even start that in this market?
Yeah, so I am long before Clayton Collins, the media and information service executive, I was a banker. So I started my career at Citigroup in New York, did a rotational leadership development program, and had the chance to rotate around different businesses inside of Citi's consumer bank, from up front lines and retail of customer service, personal banker, moved on to branch management. I had the chance to manage a Midtown Manhattan branch in 2009, during the heat of the financial crisis. And I had a chance to speak at an event a few weeks ago, a WFG title event out in Portland, and they asked me to tell part of my story. And I pulled up a stock chart and talked about kind of what was happening in the market as I was starting my career.
Oh yeah.
And and for anyone who's not familiar, 2009, all bank stocks got murdered.
Yeah.
And being the front line in a retail branch in Manhattan, it's a different clientele. It's a clientele who's aware of what's happening in the stock market. They might be investors in some of the banks that are going through troubles in that period during the GFC. And that period taught me, from a leadership perspective, the importance of communication and bringing value to your team, clients, and audience in every interaction. And when you're operating in a market that's moving quickly with a high degree of uncertainty, leaders need access to fast, accurate, reliable information.
That's right.
And so that really early point in my career, 23 years old, managing 23 people, I hosted a retirement party before I was 24. Wow. I had to learn how to have the most accurate information, leaning heavy on Bloomberg and Wall Street Journal because they were reporting so quickly, and Charlotte Business Journal. The first time you and I crossed paths is when you were at Movement.
Yes.
And Adam O'Daniel, who was in marketing there, he was the reporter covering what happened at Wachovia and Bank of America in 2008, 2009, 2010. So when I first met him in the mortgage industry, I was like, wait, you're the guy who I relied on for information at the like pivotal point in my career and in the global financial market. So that's kind of an aside. But started my career as a banker, went through consumer banking, moved into a role in sales and marketing leadership at Citi and HQ. Then went back to business school, went into investment banking. And in investment banking, I fell in with a group that was doing a lot of tech and media deals. And we worked on a bunch of sell-side transactions for a large global media company, selling off some of their smaller non-core businesses. And I had the chance to lead some of those transactions and like go out with the general managers or executives of those business units that were being sold off and like lead the roadshow, like help through the presentation, manage the sell side process, and loved that. Just absolutely loved the process side of buying businesses or selling businesses in that scenario.
So why do you learn?
What's that?
So there's a lot you can learn through all of those different ones as a young leader, and you're getting exposed to all these different sectors in the industry. Yeah,
you're getting like you learn the financial side, the modeling, like the strategy, but you also learn creativity. And so like one of the coolest deals I worked on was we were selling a business called petfinder.com. And it was positioned as a media business. We ultimately got super creative and started thinking of it a little bit differently. Petfinder.com is a digital media business that helps people adopt pets. It's a content business, and like each of the pet profiles is content that people come to. And so like the basic way to look at it is media, but the reality is it's the world's largest database of pet owners. And so we ended up positioning it at like in that regard and sold the business to Nestle Purina. And Nestle and their Purina business is one of the world's largest providers or marketers of dog food and pet products. And Petfinder found an amazing home inside of that business and still operates within that Nestle Purina business unit today. So like from an M&A perspective, and they've improved it a lot. I was just on the site or on the app a few weeks ago. I was like, oh wow, this like got better. So it's cool. They found a good home. But from an M&A perspective, it taught me about creativity and uncovering ways to create value. And after a few years on the M&A advisory side and like, having that kind of operational and like creative kind of muscle built up a little bit, I was ready to go out and do something on my own and start a more entrepreneurial path. And that's kind of where the HousingWire story starts. And I actually didn't found HousingWire. I started a business called HW Media, which is the kind of the operating and holding company that I used to acquire HousingWire, and then has subsequently been able to add on other businesses that have been important capabilities to the overall company we're acquiring or we're building here. So HousingWire was a platform. In 2020, we were able to acquire Real Trends from Steve Murray, who's an incredible real estate expert. It's probably one of the like foremost and most important experts on real estate brokerage, M&A, and valuation. But in that part, had built a great data media company around real estate brokerages. A few months later, we acquired Reverse Mortgage Daily, bringing in a big part of that reverse audience and kind of an editor who's just phenomenal on the reverse beat. And in 2022, we completed an acquisition of Altos Research, which is a huge strategic part of the vision as we start to build at the intersection of media and data and research, and knowing that the world of content has evolved a lot from narrative-driven journalism to journalism that's matched with proprietary intelligence and data that users, in our scenario, real estate and mortgage professionals, can use to actually make decisions. So
you've added a lot of different pieces to this.
I
hear you sharing.
Sorry if I just I
forgot them all.
Threw up that whole story there, but
I think it's good context for people to realize.
It's been a 10-year journey since I left banking to start HW Media. I spent a few years searching for acquisitions and figuring out the strategy, and we closed on the HousingWire transaction in April 2016, and as we record this episode, like mercy, that's almost 8 years ago.
Yeah.
So the path continues, but we are building at this intersection of media and data for housing professionals.
Yeah.
HousingWire is our core platform and our core brand, and everything we do is to support having the best team of business journalists out there who cover everything in housing, and arming them with data and research to uncover insights and help the audience. And business has lots of different revenue lines, has evolved a lot, but at the core, it's helping housing professionals have the full picture of what's happening in the housing world.
Well, we're thankful because it's not available. And you look at where do you go for things, and now that the podcast is released and things, I go, if you're going to pick one podcast to listen to and you want to know about what's happening in the finance side and the housing data side, go listen to Sarah and Logan. Like,
yes,
that's it.
Yeah,
like,
on their HousingWire Daily. Mercy, I don't know how. Sarah's got like the heaviest lift in in content production. So they're doing a daily podcast, drops every morning at it's like 7:30 or so. So they're recording in the evening before. Sarah hosts every day. Logan is a regular guest. Our managing editor James Kleiman's a regular guest. But it is a digest of what's happening in housing, and a quick path to making sure that as you start your day, whether you're an originator talking to referral partners or borrowers, or an origination leader talking to your LOs, or a real estate broker helping inform agents, you have the information you need to be that person that I needed to be in 2009 when I was walking into this dark scenario of uncertainty and needing information to help propel my team forward and make sure they have the confidence to unlock the doors, let customers in the branch, and actually answer questions about FDIC insurance and what's happening in the banking world in that really dark day. So we're trying to be that source of confidence and intelligence for housing professionals.
Hey guys, it's Brian here. I hope you are enjoying the show. By the way, if you're an entrepreneur or a solopreneur looking to grow your personal brand, make a bigger impact, maybe increase your leads and grow your revenue, let's help you get started today by connecting up with my friends over at the Brand Builders Group. You've heard me talk about them, but if you're new here, this is definitely the first step to get you started in turning your reputation into revenue. Head over to freebrandcall.com/Brian Covey. Again, to set up your free brand call, go to freebrandcall.com/Brian Covey to set up a free strategy call with one of the team at Brand Builders, and they will dive into your specific goals for how you want to grow your personal brand. I can't wait to hear how it goes. Yeah, we talked about Dave Savage the other day, one of our mutual friends. The data-driven professional today is going to outperform the person that just relies on sales skills and hoping they can market well enough. Is once they get a choice between the two of you, if you understand the data and where things are going and you can educate your customer in a way, they go, I'm just going to go with Clayton because he seems to understand all these things that I don't know how to make heads or tails of all the information.
And thinking about how Dave thinks about data and intelligence, there's market intelligence, and then there's borrower and situational intelligence. I was watching CNBC last night when I got into the hotel here. And I think everyone in the industry has probably seen the massive marketing blitz that Homes.com has been on the CoStar business, and they have a new ad out there where they're it's God, they have a bunch of ads, but the one that says "We did the homework" and the homework, and it's clever, but it's in tune with what borrowers and home buyers expect right now. They expect their mortgage advisor and real estate professional to have done their homework and understand their borrowing capacity and help them through a pre-approval process and help kind of digest what's happening in rates right now. What does it mean to borrow at 7%? Should I expect the ability to refi at a point in time? What happens if rates come down to 5.75? I have a view of what happens in that market, and we can go deeper there. I think that I think that the borrower is expecting the professional to have done the homework. And I know when Dave talks about data and intelligence, he's talking about a world and a vision where the mortgage advisor has the full picture of borrower information in front of them, and it understands motivators features and capabilities. And we think the same way about the market side of making sure the housing professional has the full picture of information about what's happening in inventory. Why is it there's only 500,000 active listings in the U.S. right now? Being armed with that information is incredibly important as you're talking to a borrower who might have wild expectations about like their ability to bid under ask or like find the home of their dreams for the price they thought they should have paid in 2019.
That's right.
It's the market intelligence that helps people give informed advice.
Yeah. Well, let's go there. Since you brought it up, I got a few tracks you've laid that I know people are going to go back. Hold on, Brian, you guys need to talk about this. Let's talk about that because, 7+% rates just right now as we're recording this, somewhere around there, depending on your credit profile and all those things, right? Throw all the disclaimers for a second. You mentioned 5.75. If it gets there, the rates have dropped slower than we thought this year. We're seeing some of that. And you mentioned you think something might happen around that number. What are you seeing and what do you think is ahead for our industry? Because that's what everybody wants to know is like, is there a refinance boom? What's going to happen with this low inventory? And you brought up, okay, if things get to 5.75, you think something special is going to happen there or a thought on what could happen?
I think that predicting mortgage rates is a very, very hard game to play. And every economist who spends way more time on this topic than you and I do has been playing the same game for the last 18 months. And I call that game the kick the can down the road game.
That's right.
And like forecasts of a rate environment in the second half of 2023 were pushed back to the first half of 2024. And in the last 30 days, those same forecasts have been pushed back to the second half of 2024. So we're playing this game where forecasts, on volume and rates just keep getting pushed back a couple quarters. And that's a tough reality because you see originators and agents out there like creating content like you and I talk so much about and talking about forecasts that they're hearing from credible economists and forecasters who isn't coming to fruition. So I'm taking a lens in 2024 that I am not making any major bets or like planning my business around a significantly lower rate environment in 2024. What I am planning around is the difference between low rates and volatile rates. And one of the things that our research team between Logan Motoshami, who you've had on the show recently, and Mike Simonson, who leads our Altos business, one of the things that they've uncovered in the last 2 years is that volatility in rates is actually a bigger driver of applications and mortgage production than the actual like rate itself. And the driver there is psychology. So consumers get really freaked out when rates are moving quickly, whether they're moving up or moving down. So rates moving up really quickly, say, whoa, I'm gonna sit on the sideline and kind of see how this plays out. Like what I could afford at 6% is X $100,000 less than what I can afford at 7%. So this isn't attractive. But when rates are coming down, there's also a psychological factor of like, well, rates moved from 7.25 to 6.75 in the last 30 days. I should probably just wait another 30 days and catch them at 6.25. And like, that's not how the market's moved. No. And so there's a psychological bend when rates are moving quickly. Despite the fact that rates today, as we record this episode, are higher than they have been in the last several months. And I talked about CNBC earlier. CNBC dropped another headline this morning on their weekly applications data that mortgage apps from the prior week took a massive drop due to rate increases, while we believe it's actually rate volatility that drives that drop. That has a psychological impact on the consumer, puts more people on the sideline. But when you look at like overall movement in the last 6 months, the rates have been kind of bumping around like the 6 3/4 to 7 1/4 range, which is relatively stable. Yeah. So what we anticipate is a slightly return to normalize like spring and summer home buying and selling season, but certainly not like this bull rush of like buyers coming off the sidelines. And if you listen to Logan and you've had him on the show, Logan will keep pounding the table that home sellers are natural buyers and home buyers are former sellers, and people who own homes don't sell their house and decide like, well, I'm going to go be homeless now. And very few sell their house and decide I'm going to go rent now. Like most home sellers come right back to the market. That's right. So what we need in the spring is more people listing their homes and moving, whether that's the upgrade, the school district, the growing family, the job relocation, like the downsizing, like whatever it is, like we need people to come off the sideline. That takes psychological confidence, which I think is one of the most important jobs that a loan originator and real estate agent can bring to a homeowner. And I don't mean that through the lens that, you know, you've heard the jokes that like a real estate agent, like, you know, it's always a good time to buy and sell. I don't mean it that way. I mean it through the lens that helping a consumer have confidence in their decision, understand the decision they're making, understand that, like, should we give credence to like the marry the house, date the rate concept? Like, should we have a better term for that? Like
we should
talk about like what the rate environment means, what inventory looks like. And kind of going, is that the path we want to go down there?
Yeah. And I mean, I like the way that you just said that, because I do think the psychology of it people don't talk about, which really lends itself to all of our originators and real estate agents that listen to this, even financial planners. Like we have a segment there. It's the same thing of creating confidence to go, this is where you want to go. We're going to need to make decisions. The best thing I heard from David Bach, which was like right around that same time, like 2005, 2008, somewhere in there, is he said, you should focus on your time in the market.
Yep.
Not timing the market.
That's real estate. That's investing. That's owning and operating businesses. I mean, that's everything. I think you can even start to apply that to like your personal life and like marriage and family. It's about like, you know, the commitment of time, not like when you start or when you stop. So talking about timing, the biggest concern I have, and I don't think about 5.75 as an inflection point that something happens there, but I do think that as rates migrate down, two big drivers on that. So watching and listening to the Fed. So like, is there actually a reduction in the target rate from the Federal Reserve? That can have movement, but it's not direct. The other big one is spreads. And like right now we're in this environment where there's still 250, 300 basis point spread on top of Fed funds rate. And that is driven by lenders' concern that as rates come down to that 5.75 range, we're going to be faced with a massive refi boom, and we're going to have EPOs and the value of mortgage servicing rights and the value of mortgage-backed securities are like pricing in this like expectation that the tenure of a loan at 7.25 is not as long as a tenure of a loan at 5.75. So the loans are less valuable. They need to be priced up to make it work. So that's another area where stability is our friend. The longer we stay in a rate range, the less spread there needs to be on top of the Fed funds rate. So like talk about consumer psychology. Now we have like the capital market psychology of like how loans are actually priced.
Yes.
And the longer we stay in this range, the more stability we'll see in the spread. We'll see that come down some more. But there's a very real possibility that like things can move very quickly to the downside, because the minute the Federal Reserve starts signaling what they're going to do, that gives capital markets confidence. So you could have two things working at the same time: confidence and the Fed funds rate coming down or confidence going up, funds rate coming down simultaneously could have a big impact on mortgage rates.
That's right.
But the Federal Reserve knows that, and they're being very cautious, because what happens when we see a 5 handle in mortgages is home price appreciation will shoot through the roof. And we're at a point right now, most recent Case-Shiller numbers were 5.5% home price appreciation in 2023 in an environment where very few transactions happened and mortgage rates were very high. 5.5% home price appreciation.
Strong.
Feels low when you think about the last 3 years, but still
compared
incredibly
to what
high
we were told we would
comparatively. And so the Fed understands like the impact of home price appreciation on inflation. They understand what rapid home price appreciation does to some of like the charters of the GSEs, which is supposed to help like in a way support affordable home ownership and first time home buyers. And runaway home prices are not good for the housing economy. So as a homeowner, love seeing my home price shoot up. You know, check the Zestimate, check the other AVMs. Like, feels great when you see your home price shoot up. Reality is I'm not moving, so all it means is higher taxes. But but it still feels good. But if you're not a homeowner, it is a wall that keeps getting higher. And a rapid change in interest rates could make that wall even higher. And that's something as an industry we have to think a lot about. because as that wall gets higher, it's going to put increased long-term pressure on origination volume. And you open the show up with talking about this reduction in loan originators in the industry. We're seeing the same thing on the real estate agent side.
Yeah.
And we're going to go into 25 and 26 and beyond as a smaller industry from a headcount perspective.
That's just the truth. And a lot of people are struggling with this right now. So I'd love to talk about this a little, because we're both on LinkedIn, active there, and you see all these posts, and everybody's like, this is happening, and there's layoffs happening, and nobody wants those things.
No.
But there's a reality in an industry when it shifts for whatever reason, because technology replaces certain functions and roles, or the industry capacity and volume is just not there. And I always say, if you're making 10,000 widgets and then your company is only making 5,000 because that's the demand, that's what you can produce, that's a profitable size organization, that's just the way it all comes together, you probably don't need the same headcount to do everything you did. And that 50% drop we saw last year, most could not really figure out. And they go, well, what do I do now? Where do I go now? And it's this chasing. Well, I'm going to go to a different model. I'm going to go to this. This is going to solve my problem. The reality is we probably don't need as many people.
We say that now, but the mortgage industry has been historically terrible at actually building efficient models where
One of the worst.
Like we can see an increase in purchase or refi volume and actually handle it with technology and existing headcount. No. The mortgage industry doesn't do that. We rush to recruiting. We overpay for ops position. Someone's going to take offense to that, but like, let's be real. 2021, mortgage lenders paid way too much money for a lot of operations roles, and they're still dealing with the hangover from that today. Some lenders were, realistic and like reduced headcount, reduced cost structure really early. Those folks looked kind of weak in 2022 when they came out the gate and like did massive headcount reductions and cost reductions early in the cycle. Today, those are the players who actually have cash in the balance sheet to put their foot on the gas and like fight for market share. It's a very clear correlation of when people decided to right size their cost structure. The players who hung around too long holding a cost structure that was fit for a 2021 or 2022 volume, they're suffering right now.
Mm-hmm.
And they're still holding on to headcount. But they're doing it, and it's in a way that like it's kind of backing them into a corner of desperation, just like praying for like a different rate environment where other operators aren't praying. They're making decisions, and those decisions aren't always popular. Those decisions are painful, but it is a reality of the industry that we've operated in up until this point. So the question is, can technology, big topic of can AI actually help originators, mortgage bankers build more efficient models that can handle an influx of refis as rates do inevitably at some point come back to the sixes.
Yeah.
The longer we stay in the sevens, the higher volume of loans that are originated at this elevated rate environment is going to be naturally, which these are loans that are going to get refied at some point. There's going to be a small bump in refi in the second half of 24 or 25. Like it's going to happen. And I can't wait to see if people actually learn something. I don't know. It's not learn something. Everyone knows it, but like actually willing.
Yeah, that's what I think about. Is what will they do different going into that, knowing the cycles we've just recently experienced?
Build or buy the right technology and integrate it the right way, and then the reason. So we're sitting next to a CTO from a mortgage bank right now. She would probably say like Clayton, that all sounds great, but the regulator will raise their hand the second my underwriters start doing 8 loans a month instead of 5 loans a month. And so like, can regulators actually like come on board with the idea of a more efficient industry and realize that technology doesn't mean a lack of quality in processing and underwriting. It actually could be an increase. It could be as we automate more income and asset verifications, get rid of I feel like, oh my God, I feel like this is 2018. I'm about to say like, get rid of the checking checkers. Yeah. But here we are 6 years later having the same conversation that we had when we had the margin squeeze of 2018, 2019.
Yeah.
So maybe I'm getting jaded, Brian. Maybe I'm like too optimistic that we can actually change. How many years have we been talking
about tech? And that was something, we had a conversation the other day with another, you would know this leader, and we're both going, okay, what's the tech and in stages? And I love that some of us are having a conversation about like, we're going to stage the tech, meaning where can you attack today that you have the biggest either cures or leakage in your system that's costing you money today? Because if you can associate that, we're going to use AI here with closing disclosures, right? Just simple, or verifications of income and asset, which we know, or VOEs, HOI, like simple things, to your point. Where can you phase it and start having thousands and then hundreds of thousands of dollars of savings? Now you're affording the staff. You're not doing things there. Whereas versus, I'm going to come in, I'm going to overhaul it. We're going to have the best tech by the end of the year. And I love, everyone has the best tech stack till you dive underneath the hood.
Yep.
And it's like,
how's it integrate? How's it work? And how empowered are your people to use it to its fullest?
That's it.
The initial wave of tech innovation was very process focused. So we were talking about point of sale and like the sexy front end that like made people feel like a true digital lender. And then COVID came and all innovation happened on the back end. Like how do we facilitate virtual closings and like talk like innovation in title and valuation when appraisers couldn't go out. So we actually saw some innovation like forced through that period. And as we come into this where we are now, where we've been for 2 years, is innovation in the middle. So all the examples you mentioned and verification and underwriting and processing, and then post close and disclosures, like that. There's a massive opportunity there. And I don't even want to say opportunity for innovation because the work's been done. Now it's like adoption and integration.
That's right.
And can you design your process? Can you empower the people in your company to change things? Can you build a culture where the people who need to leverage technology don't feel that it is going to replace them, but instead the people who use technology will just become more superhuman and be able to accomplish more without needing to scale up large operations teams around them.
That's what we envision. That's my vision of how do you take somebody that's able to do, let's just say 15 loans as a processor, and they can do 30 because some of those verifications and technology we mentioned, and they're so good at their job already, they just get efficient in areas that are dragging them down today, and normally would have to take a head count to solve it. Like, where do they start to leverage tech?
Well, tell me about Revolution. So what is all right, so what does the business look like today, and how does it, from a tech perspective, and then how does it change if for some miraculous reason volume doubles in the next 18 months?
So we just left our summit. So I'm coming fresh off of Femi, who heads up our tech side and integration, all this. And I loved listening. I'll nerd out on this stuff. I'll tell you, it starts at the top. This has been my belief. Like every company I've worked at, and I've worked for, I would say, hands down, some of the best, the most elite companies out there. And if your CEO is not all in on the technology, and I would even go so far to say today, Clayton, hands-on with that process, you can't delegate or automate that out. They need to be involved in it, envision it, and see, what do we envision our team doing?
Yep.
A processor, an underwriter, a closer, compliance, marketing, loan officer, branch manager. What do you envision people doing? Because if you don't have that clarity, you're just throwing tech against a problem and thinking it's going to solve it. It won't. So it starts with the CEO. And we started to envision what would it look like from point of sale when that customer first interacts, through the loan officer who gets to speak with them first. And you have to then model it through to see what's there. We started to find out, where are the leakages? Where are the issues that we're losing money today that we could go in and solve? And so we've been attacking the things I mentioned around the closing disclosures, the initial closing disclosure there, final closing disclosures, verifications on income and assets. And your tech needs to be all built together. So like ours, I look at it like you're building a house. Your foundation is your point of sale system. Then you start moving up and you're building the house. Now I'm thinking of customer facing, right? And so we have Encompass, and you have Simple Nexus, you start building it up. What's the customer feel like? Can they upload docs easy? Can they complete their application? Does it encourage them to give complete information?
Yep.
Does it have hard stops within there? Then you talk about pricing. With getting some of our tech, we moved from Optimal Blue to LoanPass recently. And I share that because, one, we saw that fit for us, but two, our CEO was able, willing, and also got the job done to move us to something we believe will be better in the future. That's for us, right? But we were all bought into what we're doing. We collaborated. We got feedback and said, this is going to help us as we move forward. So then you got to think about, what are the programs and products you do? Like we have a CP, one-time close. We have reverse.
Yep.
We have not ton of non-QM. How does that look in your business? And what are your roadmaps through there? And I'll tell you, then you start looking at what we just made this shift is, can you imagine like with AI, you get these little avatars of people? We actually named them within our company. The two avatars that you get AI, they're doing things in the
What are the
background.
names?
We're running through. Oh my gosh, you would ask me, why am I forgetting? We went through them. I'll send them to you because I'm drawing a blank of, I see the emails all the time. But we went through these two and actually humanized them in the way, because they're characters that you have over here. And then you look and go, well, hold on, I just got an email. Like, that's a real person. It's really an AI person checking things. Well, the more they go through it, imagine checking your initial disclosure and seeing that you might have missed something. Well, it gives you real-time feedback. So not only does AI help solve the problem, but the human on the other side of it goes, okay, Clayton, I just got real-time feedback about the loan I submitted. I missed a fee. I was off on that fee. I can change that next time. So to me, there's this back and forth. The more we run through it and automate it, we're getting real-time feedback.
So we know that originators are ready, willing, and able to handle more volume. Like they'll take it when they won't complain, because it means more commission. But what about operations? So like how do you handle a Revolution if you see volume increase? Let's say we see a refi boom in the second half of the year, and like volume increases by 30%. What does that mean to headcount in underwriting and other ops roles?
So today what we're already seeing is that operations attack of making sure, how do we get productivity and training up and using the technology. There's things that customers could be doing, whether it's automating, let's upload your bank statement, let's upload your income verifications, all those tools. If their team's not trained on it, they may just say, hey, send me this, send me that, let me do this. So what we're already looking at is the technology today will eliminate some of those functions that they're having to do today. And so you got to look and go, if somebody's able to do 12, the only way to get them to 24 is to think about how one training I think is missed in our industry.
Yep.
You hire a processor and you go, I mean, they're a processor. They've processed for 5-10 years. But the reality is within your system and the technology that you continue to roll out, are they constantly trained? And so we moved Sherry, one of our trainers. She's been in underwriting, processing, all that. And she's actually working with some of our processors. Okay, where are their leakages in what your day is?
Yeah.
Where are the productivity things that you're not doing? Cross-training to me is there. Then you partner that with technology. Now you've got efficiencies.
So is that training also like saying like, hey, this part of your job that you've been trained to do for 5-10 years, decades, this is no longer necessary because technology is doing it. That is not a threat to you. That is your ability to go to your highest and best and focus on this. Like, is that part of the training?
And I think that's the communication most lenders or leaders are missing is, hey, we're going to help you go from here to here. And that's actually job security, because some of the people are going to adapt sooner. They're going to embrace it. They're going to do these things. Some are going to go, I don't want to do it that way. Like I've always done it this way. And I also see that in the branch of what's the line of how much do you do in the branch versus how much does your processor do? And we've talked about this for 2 decades I've been in the business, is a 1003 should tell a story in such a way that an underwriter looked at it and they didn't have a conversation with you. They could look at it with your notes and go, I understand this customer. And we're still, the disparity between that is so wide. So we talk about it starts at the front, and to be elite is a word we use a lot. To be elite is to be the person that had the conversations, asked the question behind the question, so that when you do hand it off to your teammate's like, man, this is phenomenal. Thank you. Now I can be more productive.
Yep.
Now I'm going to do my job to be elite, which is I'm going to use the tech. I'm going to do this. I'm going to do that. All my checklists. Great. When I hand it off to my next teammate, I think about the runners that they go around in the group racing, right? If you don't hand that baton off correctly, what happens?
The whole relay team like is done. Like the race is over. Like the handoff is the whole thing.
That's it. So we think about you're a relay team because it's going to touch all these people every time. Every time.
That's a great analogy.
And I just think of it that way. But all I'd say, when it starts to go up in the volume, we have a plan. And then what I love about our size and scale is we can adapt. Because we have underwriter pods, we have dedicated processing, right? We got closing teams. But what's going to happen when that volume starts to go up? We already saw it as we've hired a lot of big teams this year. We already had our credit pulls go up by almost 40%.
Dude, I've seen that. I've seen and heard that from multiple lenders in the last 45 days. And like, I think there's a total bifurcation in that story. There are lenders that are seeing credit pulls up significantly over last year and December and last quarter.
Yeah.
And there are some who are not. And and you think about like what separates the bifurcation there. Yeah. And that all brings me to this concept that I think we're going to see play out in the next few years. And at HousingWire and our leadership team, we talk a lot about the flywheel. For us, the flywheel is moving helping move audience through different capabilities inside our ecosystem. So we might attract somebody with news and they sign up for a newsletter and then they become a member and subscriber, and they might attend an event or sign up for our Altos data product, and like the flywheel continues and like we add more value to them, and we also like gain from a business perspective through like additional like sales opportunities through the flywheel. The way I see the flywheel working in mortgage is kind of like that. Success begets success.
That's right.
And the more successful you are at growing volume, the happier your originators and team is going to be, because they're earning more money, which improves retention, which reduces costs associated with recruitment and other areas, end up sucking a lot of cash out of the business, which gives you more resources to invest in tech, which makes the business more efficient, which helps you be more competitive on pricing, which is a little bit more competitive.
That's right.
Or bring in a new product in the organization, which makes the originators more successful, which keeps them around longer, which helps you invest in tech, which helps you improve pricing. So like I think this bifurcation is really important to pay attention to, because it's not a one-time thing. It's like a bifurcation that gets wider over time, because success begets success, and the stronger get stronger.
Yeah. Well, I think we're already testing what I will say is that jump in credit pulls and new teams that come on is giving us real-time experience and feedback. Okay, how's our underwriting doing when we get all these new loans up? Maybe it's a different product or something that's new. How's processing doing? How are we setting that up? How are we doing overall? So we're already seeing surges when that happens. And I love it, because we rolled out reverse and CP in the last year, which immediately building a program and going through that, you realize, okay, this is what would happen if our volume shot up and doubled. And so I love the real time. To me, you can't beat the collaboration. But I want to shift, because you talk to a lot of leaders and a lot of companies, and we're all kind of wondering what's going on out there. I mean, the mergers that have already happened, the ones that are rumored to be happening, coming up soon, and all that. What are you seeing and hearing around just the overall health of some of these mortgage companies that we talked about, the years we've been through, some great ones, and then some really tough ones? What's happening out there that maybe we don't know and see?
I think the M&A environment is highly uncertain right now. And 2023 had fewer deals than anybody expected. We expected to see more consolidation, but what ultimately happened was more recruiting and more walkovers. And so like the term walkover is a M&A term not used often in housing, because the M&A transactions are usually, has some gusto and pomp, and people are excited about them. There's been some quieter deals in the last year, not in like, the top 20 like HMDA list, but like in like mid-market mortgage banks. There's been some quiet mergers and walkovers that didn't make the headlines, didn't even make the pages of HousingWire, because they're like were done quietly.
Sure.
And then the deals that we're seeing at the the upper end of the market, they're not as like, they might be like dressed up as like a really big strategic celebratory transaction, but some of them are out of necessity. Mm-hmm. And I think that's a tough line to walk as you think about M&A in this market right now, because there is power and scale. So like we're talking about like tech and pricing and resources, like those are hard things to invest in as you're coming off of a down cycle in the industry. Cash has been drained for one reason or another. Origination volume's not keeping up with where you want it to be. Maybe you over budget a little bit for 2024. So there's some people looking for life rafts, and they see the power of like, hey, if we combine forces here, we can actually deploy an AI strategy and like have the combined resources to get this done. So I think that's one of the rationales. From a deal structure perspective, I don't think there's a lot of cash changing hands. I think there's a lot of earn-out deals being structured where the biggest value that is brought in some of these M&A transactions is a leader who can bring originators with them.
That's right.
Which has also been really hard to do in this environment. And like it's been a straight up uphill climb to do an M&A deal and actually bring your originators with you. One of the reasons for that, and this exists in all markets of M&A, is like we compete. Like this is a brutal industry. We all sell the same 30-year fixed rate product for the most part, and like the differentiation is your marketing, your sales, and like a smidgen of like price and tech in there.
Sure.
So people compete against each other, and suddenly your mortal enemy is now your colleague. And like
join forces.
And that joint forces isn't always received very well. And I think people see deals as an opportunity to pick their head up and say like, hey, well, cool, my company's doing this deal. It didn't really benefit me, so I'm gonna like go out and like see what else is out there as we go through this transition period. Like that's happening a lot. People are picking their heads up. As
just the one the other day, Draper and Kramer.
Yep.
I mean, it's almost a fractional. Like they went different ways. And you go,
yeah.
I mean, they could have. Who knows how long some of those will stick? I've been watching some that have happened, and you often wonder too. Okay, they got over there. Maybe they got a package to come over, whatever it is. How long do they stay? Because we're already seeing, like I'm seeing this, Clayton, is even this week, 2 people, large sign-on bonuses, those have expired with their commitment, how long they need to be there. They're leaving.
And God, the sign-on bonus thing is a whole nother story. And it ties back to data. So a lot of the recruiting and like the big packages that were, done in a peak period or even the last 18 months were done off old data. And right. There's signing bonuses that were structured off of just lagged data and like no shot at the originator hitting like those targets or maintaining that volume.
Probably ever again for some of them,
so,
to be honest.
And it just blows my mind. I mean, I'm not going to... There's smart operators out there that are doing this recruiting, but there's been some mistakes that were made in terms of using old data and the way terms were structured or in the people that were targeted. So there has been an evolution of like where production is coming from. There's a lot of top originators out there right now who are building their business through social and other forms of influence and attracting people and referral partners. A big part of that shift has been a shift in the real estate industry. Yeah. So there is I'm a geriatric millennial, the old end of the millennial population, and we were never supposed to buy houses. We did, and the generation after us is as well. And like this new first-time home buyer cohort is doing a lot of business with their peers and other 20 and 30 something real estate professionals. So the originators that are connecting with the real estate agents that are doing the business today are really important sources of business, and the agents that were doing amazing business in 2018 might not be like the referral partner that they once were. Yeah. And so there's a shift going on as real estate shifts, as buyers shift, the best referral partners shift for retail or referral focused originators, and it's a shift that happened pretty fast.
Big time. I'm anxious to see where these all shake out and what the data tells us years from now of the people that took the sign-on bonuses, how many stayed and for how long, and all these things there. And then that brings me to it's kind of a touchy subject. People might not want to, but the amount of lawsuits and the amount of mudslinging that's going on.
Yep. I think that's going to happen in any market when times get tough. Like people are like we talked about this bifurcation, and like your people are searching for their lifeboat and or fighting. You're like they're in the trenches. They're in like fight or flight mode, and so I think anytime you go through a really bad market cycle, we end up seeing like the worst of ourselves, the worst of the industry, which is a real shame. Like, I mean, our industry, I think we, the mortgage industry had a really long uphill climb after the GFC in terms of just getting like back on its feet, reputational, like getting the right originators in the right seat. And like now we're going back through like another mudsling at ourselves this time instead of mudslinging by mainstream media.
Yeah. Pick a different target as the enemy.
Yep.
And it's not the company down the road from you like you think it is. It's the news that's inaccurate. It's all of
or the
different
channel.
Channel things.
That blows my mind on like Jesus. But.
I know, which we could jam on forever. And I always say this, I have so many good friends in different channels with that, and if people want to get down to like, I'm doing this because of this, I'm like, hey, if we were just to open it up and like be completely transparent about it, like we can all price within certain ranges. We all have different models. You can set your comp where you want. Like, it depends on your market and what you're doing and like what you actually bring in. People are like, they've forgotten. What do you bring into the equation? So that I remember one of the first mortgages I got, I never even shopped or looked. So I'm like, you know what? Person I worked with, you're so good. You're walking me through it. You're educating me on it. I don't even want to go do that again.
Yep.
Like that hour or 2 hours they prep you and go through. Most people don't even want to look in the mirror and say, what am I doing so that people aren't going other places? They only think of me. And if they do shop me, they go, I'll talk to someone else, but man, they're not as educated, informed, or they're not as good as working with Clayton. And so let's go back, as you mentioned at the beginning, you're like, hey, I talk to people, which I'll take the compliment and I'll kind of work it back in with people see things that are done differently out there. What are you seeing top originators do in the market? Speaking of social, speaking of that direct to consumer, could be marketing agents. What are they doing that you're seeing work?
I mean, you hit on a big one 30 seconds ago, and that's like selling expertise and selling knowledge and actually helping people make decisions and not making assumptions that the average homeowner, even if they're repeat buyers, done this a few times, understands the market that we're in now. Mm-hmm. I'm sure that you and your team have worked with borrowers who bought their last house in 2005 or even 2015 and might not understand the process that, like, what the process looks like today, for better or for worse. And so like being that originator that can sell knowledge and expertise and guidance instead of the originator who just sells price, really important. Price matters, right? Like everyone wants the best deal.
Yeah.
But like making the decision is half the battle. So like being that informed originator is incredibly important, and a bifurcating factor. So to be that informed originator, you have to have a mindset that's focused on a level of positivity, a level of confidence in the market, a level of confidence in your abilities and knowledge. And like that's a big like bifurcating factor, especially in a world where agents are tired of like the doom and gloom. They're going through their own chaos right now with lawsuits in different states focused in on the way they're paid. That's stressful. Like you don't want the way you're paid and your profession being like dragged through the mud from people who don't really understand the industry as well as the
headlines aren't helping.
Yeah, no, it's brutal. So agents have like their own tough environment that they're working through. The last thing they need is a loan originator who's like, man, it's so tough out there. Like you don't know what's like. Don't care.
Yeah,
I got my own stuff going on. Like I need you, Brian. I need you to be like the positive center of confidence and like helping me advise clients to close on transactions of these amazing homes that I'm showing them every day or week. So like there's a mindset difference. There's also a tool difference. So like I talked about a few of the lenders that I think are doing things differently. He's been talked about a lot, but another gentleman who's like doing something pretty special right now is Greg Sherrod in FM. Yeah. We've talked a lot about him and the way he's building his influencer division and using content as an attractor. You mentioned earlier the power of attracting executives and using like content and like this podcast is a way that you attract like-minded people. I think attraction is a major tool that's being used in different ways across the mortgage industry right now. So if I think of organizations that are on the right side of bifurcation, they are attracting the right talent because they have expertise, they have the right tech tools, they have some of those advantages we talked about in the flywheel.
Yeah.
They're attracting because they have an executive team who's market facing and available. They're attracting because their originators are demonstrating success, and so like their colleagues from we all know like most origination leaders and originators have been at several places and stops in their career. So there's a whole world of former colleagues that can attract. You're attracting real estate agents with your expertise and knowledge and ability to get deals done. You're attracting borrowers and home buyers because they recognize the right expertise. So it's God, the word attraction just like has to be so front and center in the way that we do business in this increasingly digital market facing world. Yeah. And like, it's not all about like sales and lead gen and like, the last skill set that was incredibly important in growing a business. We are in a market where those things matter, but you also have to know how to attract the right people.
Yeah. Most don't. The attractive leadership model, and we teach that. And one of my friends, Richard Milligan, came up with that. And then I took it to this other level for what we do. And I'm like, that is it. Because imagine not cold calling people and having to figure out what goes through there, but you have conversations. Yep. And every day people will reach out like, hey, I'd love to chat with you about this. Love it. And it's like, wouldn't that be great in your business if you attracted?
Yep.
And you talk to CEOs.
And attract not just because like not being afraid to be attract or being different. And like my chief of staff at HousingWire, Alex Bridgman, hosts a podcast about small business entrepreneurship. That's how we initially met. He had a guest on this week talking about like how nobody loves a cover band. Like you don't like you want somebody because of their like unique style capabilities, and like you don't like you might. I mean, I love going to a cover band show as much as the next guy, but I don't want to do it every weekend. I want the original.
You're like,
yeah,
oh, that's
so like
different.
Not being afraid to be different is really important, which I think was something that we're starting to see in the way people build businesses in mortgage banking. Not every mortgage bank is a model match to like the one that was successful yesterday or the one that'll be successful tomorrow. There's different flavors.
Yeah, and the same for recruits. I always tell people is, if you're a loan officer today, branch manager, whatever your title is, you got to find the model match for you. Like, what is your vision of how you're going to run your business? What's your vision for the future? And can you run a P&L model? Because it's not for everybody. Should you be on the broker side? Should you be in retail? Should you go into a bank? I'm going, man, all those in my career have served me well in different seasons.
Yep.
So find what is for you. Go in there.
And so like at HousingWire for like the gathering, we're taking a big focus on like bringing some of those like different models to stage. And like it's really cool that there are some really like diverging models that work well for people. So like we're going to have the CEO from CoStar and Homes.com on stage, as well as the CEO of the Realtor.com business, like two very different models and like the aggregation and like real estate search and data world, but like different views. They're going to be up there. Yeah. There's some amazing real estate brokerage leaders. And like we talk a lot about like the big brands, like the Keller Williams of the world, and we're going to have representation from Keller Williams. We also have Dan Duffy, who leads United Real Estate, who has a very different model that works really well for him and his people. And so like there's like that difference. They're not cover bands. Like they're not model match. And the same on the mortgage side. We have some of like the big top 10 mortgage bank executives that are speaking, giving us a look under the covers and under the sheets. What's the right phrase?
Yeah, there?
Under the hood. Yeah,
that
sounds a little safer.
It's safer. And the engine has more parts to it. I feel like the mortgage business has a lot of moving parts.
And as well as some leaders from the wholesale side. So like we're not putting some model match like this is what running a mortgage bank should look like on stage, or this is what running a real estate brokerage should look like. And if folks aren't familiar with the gathering, this is our first year doing it as like the gathering is a new brand. This is a merger of two events. So like I mentioned Real Trends earlier. We acquired Real Trends in 2020. They've hosted the Gathering of Eagles for 20 or 30 years. Like it's wild, like the consistency that brand has had, and we're changing it. And then HousingWire Annual, which has been our housing finance event, bringing that together because we kind of looked at ourselves and looked at our audience and said, hey, these real estate brokerage folks, all they want to talk about is mortgage and the other parts of the transaction and core services and cross-sell. And these mortgage folks over here, they just want to meet our real estate audience. Like, hey folks, come together, meet, do business. Let's see where it goes. So we're trying to create this commercial and learning opportunity that can fuel commercial opportunity between these different sides of our audience that do business together already, have a deep interest in each other. Most of the big real estate brokerages, our study last year showed that like brokerages had a 3.5% gross margin. That is not good before they do core services. So insurance and mortgage becomes a really important part of running a real estate brokerage. So like we're hosting this Gathering of Eagles event and 3/4 of the content is about mortgage. I'm like, okay, these audiences need to come together because they're asking questions to each other that I know Brian Covey can answer. So like, come on, y'all get there.
I'm looking forward to it because that's the audience. That's the people you want to collaborate with. And it's like, KW having their family reunion, EXP, some of my friends, they're like, when they have their events, like you have to go in, but it's not the same format where I'm excited to hear from them. What are the things you're solving for? What are the things you're innovating on? Where are your struggles that we can help you solve? We all need to be collaborating and partnering more. As we go through
the industry is getting closer together. The consumer doesn't want these bifurcate or siloed components of the process. Like they don't want to, talk to Brian on Monday and then Susie, the realtor, on Tuesday, and then Joe, their title rep, on Thursday. Like that is going to come closer together. It needs to, it's coming back to like tech and process, like the different components of the single family residential housing transaction have to be considered. It's not just the process and processing and underwriting.
That's right. Dude, I know we could jam forever. We're going to have you back on because as the year goes on, I expect a lot of things we talked about. We're going to start to see the next 90 days, like what happens in the industry, right? I think there's a lot of things that could happen. Your point earlier too about the interest rates and things that people have been waiting on. Oh, it's going to be better then, guys. What if you took an approach of, this is the market, this is the opportunity, this is what I can do to control it and go after. I think your year will look much better than being on the hope strategy bus.
And what happens to the survivors? So if we are in an industry with fewer originators and fewer real estate agents, and volume, we just talked about credit pools and which is a very forward-looking indicator. I'm going to bet if you went and analyzed your pool per originator, you're starting to see that metric climb pretty quickly and creating a pretty positive scenario and outcome for the survivors that stay in the industry. So if we were operating industry with lower headcount, what does it look like for the people who stuck around and survived and not just survived, but actually prepared themselves to grow?
Yeah, I'm excited for it. And I'm one of those on the forefront of we talked about sharing content, teaching people how to do this, how to do that. And yes, it's mortgages, but you should be doing more than mortgages to get your mindset. You talked about that as people that are actually learning new skills, implementing things to network and grow their brand. And all. I'm going, you do that today, there is less competition, there is less noise. And I really see that. That's the opportunity. We actually go out there and crush the year. And it's not 2021. But what's the realistic number that you can get to today? How many people can you serve? How many people need you? And now that we're more nationwide, I think about people move all over.
And how much better do you get through reps? It's the high producers that know how to navigate different scenarios and know how to help their referral partners and borrowers get to the best outcome. It's that success begets success. The flywheel turns. That's not just for the business; it's also for the individual.
Yeah. Well, tell me, last question. What are you most excited about for 24?
It's this. Inside of our business, I talked about how the pieces came together. We're in a big year of integration and then figuring out perfecting the marketing message around that. So far in 2024, Real Trends, which has operated as a standalone website, we just talked about how the event is merging with HousingWire Annual. We took all of the content and research from realtrends.com that is now powering HousingWire's real estate vertical. We took all of the content and news and everything that Chris Cloud, our Reverse Mortgage Daily team, has published. That is now HousingWire's reverse vertical. Wow. So we're bringing together these media pieces all under the HousingWire umbrella, bringing together the event into a single tentpole event, and also integrating data throughout the process. So we've built some data partnerships, have an awesome relationship with CoreLogic, and we work with Poly on product and pricing, and they're powering our Mortgage Rates Center. We also have proprietary data through Altos Research and a few other sources. So you'll start to see a lot of this new data flow through our content, through the website. We'll probably have some new premier subscription products launched later in the year, bringing more research and intelligence to the audience. But it's a culmination of just bringing the pieces together, which isn't without pain. And it's we have a lot of org pain and not org pain, but org change, and bringing the right teams together and the right people and the right reporting structures. That's a lot of the action that I'm focused on now. And then getting out there and telling the story and helping people understand what we're here to do and bring the full picture to housing professionals.
I love it. So gathering is April 19th?
Yeah, April 21st through 24th.
Okay, so I'm kind of early. I think that's what it was. Yeah. Okay, so 21st through 24th.
Yep.
Yeah, we'll put the link in.
You can come on the 19th. You're welcome. It's a cool resort out in Scottsdale. You might want to spend the weekend.
I was going to say, it's probably one of those, Scottsdale in that time of year, you never know what weather you'll get in Nashville if you've seen while you're here. It could be something.
I think we've seen a 40-degree swing since I landed yesterday. So
that's crazy.
No, but Scottsdale, Camelback, April 21st. It's going to be awesome. I am blown away by the speakers that our team has been able to bring in, some heavyweights.
We're having some fun with it. We'll put the link in there. This has been amazing. And I did remember one of our AI important people's name, which is why it threw me off, is Barry.
Barry, okay.
Okay, our friend Barry Beebe over there. I'm going, it's not Barry. I'm thinking about Barry. They're going, no, it is Barry. And so I'll get the second one. That'll be a bonus. If you know it and put it in the comments, I'll have a prize for you. How about that? So it's probably only our Revolution people would know that, but we'll market it and see. So thank you, my friend. This has been a pleasure. We could have covered a ton, but today I love it. We got in the meat and potatoes, what's happening in the industry, where are we going? It's always fun.
Hopefully I stayed on topic. I'm more used to being in your seat and hosting these conversations.
I can tell.
Maybe I rambled a little bit. But,
no, you had a good question for me about Revolution and all those things. I'm like, no, it's not about Revolution, Brian. Remind yourself. We're going to go that way. But I will say, if you want to learn more about Revolution, I'm your guy. Reach out and all. Guys, this has been another episode of Finding Your Competitive Edge. I love these conversations because this gives you an insight. You're probably wondering where you are. Maybe you don't get great communication with your leadership team, or you read certain articles out there. You just don't know what's happening. So you heard today, not only this conversation, but resources that the HousingWire provides. I'll tell you, I'm one of those. I jump in. I want to know quickly what's happening in the market. I can download a podcast. I can read a couple articles, and I'm more informed through my day. So whether you're a leader or an originator or a real estate agent, you know you're going to have to be on the cutting edge and have the data and the information to lead from the front, so you're not just a commodity. So I love that. You can tell on Clayton's story as well. Many of you may not have known that story of where he's been, working with the big banks, the M&A world, all of that, and what's led him into the media side and all they're doing with HW Media, HousingWire, all these companies coming together. It's a really cool picture of an entrepreneur bringing all these ancillary services together, and the company always grows. So I'd like for you to think of yourself that way, and I'll close on this. Are you somebody that's actually just running a business? You know, you're originating loans, your transaction, all that, or are you the business? Meaning you have a brand, you have people that are attracted to you, you have people that want to work with you because you did such a great job, and you're not worried about what the market does, because the reality is you're creating the market that you want, and you're actually setting up your life by design. So that's what we want you to do here. That's why we created the show. Guys, if you love the show, drop us a 5, reviews, we love those. Share it with your friends. We'll give you some more information about the gathering and all the ways you can connect up with HousingWire and also Revolution Mortgage. Appreciate you guys tuning in, and we'll catch you on the next episode. See ya.